In today's video, we're diving deep into one of the most powerful financial systems in the world, the USA stock market, a place where trillions of dollars move every single day and where opportunities are created for those who truly understand how the game works. Just imagine this. While you're sitting at home or even sleeping, the U.S. market is active with investors, institutions, and billion-dollar companies constantly buying and selling. These movements don't just stay inside America. They influence economies all around the world. From Asia to Europe, everyone watches what happens in the U.S. market. Now the question is, why is the U.S. market so important? The answer is simple. It's built on strong fundamentals, transparency, and innovation. Some of the biggest companies in the world are listed here, companies that are shaping the future. Technology, electric vehicles, artificial intelligence, e-commerce, everything is driven from this market. But here's the truth most people don't talk about. The market is not just about luck, it's about understanding, patience, and strategy. When you invest in a stock, you're not just putting money somewhere randomly. You are buying a small ownership in a company. That means if the company grows, expands, and makes more profit, your investment grows with it. However, the journey is never smooth. The market goes up and the market goes down. There will be days when everything is green and you feel like you're making easy money, and there will be days when everything is red and you start doubting your decisions. This is where most people fail. They enter the market with excitement, but the moment they see losses, they panic. They sell at the wrong time and then later watch the market recover without them. Successful investors do the opposite. They understand that volatility is normal. They don't panic during crashes. Instead, they see opportunities where others see fear. Let's talk about something very powerful, compounding. Compounding is the reason why long-term investors win. It means your money starts generating returns, and then those returns start generating more returns. Over time, this creates exponential growth. You don't need a huge amount of money to start. Even small investments, if done consistently over a long period, can turn into something life-changing. Now, another key concept is having a clear plan. Before you invest, ask yourself, what is your goal? Are you trying to make quick profits in the short term, or are you building long-term wealth? Because your strategy depends on your goal. Short-term trading requires time, skill, and emotional control. Long-term investing requires patience, discipline, and belief in strong companies. Most beginners make the mistake of mixing both. They start with long-term intentions but panic like short-term traders. That's why clarity is important. Let's move to another important factor, diversification. Never put all your money into one stock. Even the best companies can face unexpected problems. By spreading your investments across different sectors, technology, healthcare, finance, you reduce your risk and protect your portfolio. Now, let's talk about something that destroys most investors, emotions, fear and greed. When the market crashes, fear takes over. People start thinking they will lose everything, so they sell. When the market is rising, greed takes over. People jump in without thinking, often at the highest price. This cycle repeats again and again. But successful investors stay calm. They follow a system. They don't let emotions control their decisions. Another powerful habit is staying updated. The U.S. market reacts to news, interest rates, inflation, unemployment data, company earnings, global events. These factors move the market every day. If you want to succeed, you need to stay informed, not just blindly follow news, but understand how it impacts the market. And most importantly, never stop learning. The market is always evolving. New trends, new technologies, new opportunities. The more you learn, the better your decisions become. You don't have to be perfect from the beginning. Everyone starts as a beginner. The key is to start, stay consistent, and improve over time. Because at the end of the day, the U.S. market is not just about making money. It's about building a mindset of patience, discipline, and smart decision-making. And if you can master that, you're not just investing in stocks, you're investing in your future. So take your time, learn step by step, and remember, the journey to financial freedom doesn't happen overnight, but with the right approach, it is absolutely possible. Let's go even deeper into how the real players operate inside the U.S. market, because once you understand this, your entire perspective will change. The market is not just controlled by small investors. In fact, the biggest movements are driven by institutions, hedge funds, banks, and large investment firms. These players move billions of dollars, and when they enter or exit positions, the market reacts instantly. So instead of thinking like a beginner, you need to start thinking like them. They don't invest based on emotions. They follow data, strategy, and long-term vision. One of the most important things they analyze is company fundamentals. This means looking at revenue, profit, growth potential, and future plans. A strong company is not just one that is popular, it's one that consistently performs well over time. At the same time, there's another side of the market, technical analysis. This is where charts come into play. Price movements, patterns, support and resistance levels. These help investors understand market behavior and possible future direction. Now, here's where it gets interesting. The best investors don't rely on just one method. They combine both fundamentals and technicals to make smarter decisions. Another powerful concept is market cycles. The market doesn't move randomly, it moves in cycles. There are times when the market is booming, everything is going up, and confidence is high. This is called a bull market. Then there are times when the market slows down, prices fall, and fear spreads. This is known as a bear market. Understanding these cycles helps you avoid big mistakes. For example, during a bull market, many people think prices will go up forever. They invest without thinking. But smart investors start becoming cautious during these times. And during a bear market, when everyone is scared, smart investors start looking for opportunities. Now let's talk about timing. A lot of beginners try to perfectly time the market, buying at the lowest point and selling at the highest. But the reality is, even professionals can't do this consistently. That's why a better strategy for most people is consistency. Invest regularly, regardless of market conditions. This approach reduces the risk of bad timing and helps you build wealth over time. This is often called dollar-cost averaging. Another thing you must understand is patience. The market rewards those who wait. Many people enter with high expectations, but they quit too early. They don't give their investments enough time to grow. Real wealth in the U.S. market is built over years, not days. Also, avoid the trap of get-rich-quick thinking. If something sounds too good to be true, it probably is. Focus on building a strong foundation instead of chasing shortcuts. And here's something very important. Protect your capital. Making profit is important, but protecting your money is even more important. Because if you lose your capital, you lose your ability to grow. Always manage your risk. Never invest money you can't afford to lose. Now think about this. The U.S. market has created countless millionaires, but not because they got lucky, because they stayed disciplined, kept learning, and followed a clear strategy. So if you're serious about changing your financial future, don't just watch the market, understand it. Don't just follow trends, analyze them. Don't just invest money, invest in knowledge. Because at the end of the day, the difference between a beginner and a successful investor is not luck, it's mindset, discipline, and consistency. Now let's take this even further.
because understanding the deeper mindset and hidden rules of the U.S. market is what separates average investors from truly successful ones. One thing you need to realize is that the market is a game of psychology as much as it is a game of numbers. Prices don't move only because of logic. They move because of human behavior. Fear, greed, hype, panic. These emotions create patterns in the market again and again. That's why history often repeats itself. If you study past market crashes and rallies, you'll notice similar behaviors. People get overly excited at the top and overly fearful at the bottom. Smart investors take advantage of this cycle. Now let's talk about patience in a different way. Most people are not actually losing money because of bad investments. They're losing because of impatience. They want instant results. They invest today and expect profits tomorrow. But the market doesn't reward impatience. It rewards those who can stay consistent even when nothing exciting is happening. Sometimes the best action in the market is no action, just holding a strong investment while it grows over time. Another concept you need to understand is value versus price. The price of a stock is what you pay, but the value of a stock is what you actually get. Sometimes a stock looks expensive, but in reality it has huge growth potential. And sometimes a cheap stock is actually risky and weak. This is why research is important. Don't just buy something because it's trending or cheap. Understand what you're investing in. Now let's go into something powerful: income versus wealth. Many people focus only on earning money, but real financial success comes from building assets. The U.S. market allows you to build assets that can generate income over time, dividends, long-term growth, and capital appreciation. This means your money starts working for you. Instead of trading your time for money, you build systems where your investments grow even when you're not actively working. This is how financial freedom is created. Another important factor is discipline. Discipline means sticking to your plan even when it's difficult. There will be times when your portfolio is down. There will be times when you feel like quitting. But those who stay disciplined during tough times are the ones who benefit the most when the market recovers. Now let's talk about information overload. Today, there is too much information: news, social media, opinions, predictions. If you follow everything, you will get confused. Successful investors filter information. They focus only on what matters: data, trends, and reliable sources. They don't react to every headline. They think long-term. And finally, let's talk about identity. If you truly want to succeed in the U.S. market, you need to see yourself as an investor, not a gambler. Gamblers look for quick wins. Investors look for long-term growth. Gamblers follow emotions. Investors follow strategy. Gamblers react. Investors plan. This shift in mindset changes everything, because at the end of the day, the U.S. market is not just a place where money moves. It's a place where disciplined people build wealth, where patient people win, and where those who keep learning stay ahead. So keep going, keep learning, and most importantly, stay consistent, because your future in the market is not decided by one trade. It's decided by the habits you build over time. Now let's unlock another level: the habits and systems that truly separate professionals from everyone else. Because at some point, it's not about knowing more, it's about doing the right things consistently. Professional investors don't just randomly open charts and buy stocks. They follow routines. They have a system. Every day, they review the market. They check major indices. They look at sector performance, and they track where money is flowing. Because in the market, money flow tells a story. If money is moving into technology, there's a reason. If money is leaving a sector, there's a reason. Your job is to observe, not guess. Now let's talk about another powerful idea: positioning. Most beginners focus on what stock to buy, but professionals focus on when and why to enter. Timing may not be perfect, but positioning matters.
Entering a strong company at the right time can make a huge difference in your results. And just as important, knowing when to exit. Taking profit is a skill. Cutting losses is a bigger skill. Many people hold losing stocks hoping they will recover and sell winning stocks too early out of fear. Professionals do the opposite. They cut losses quickly and let winners grow. Now let's go into something that almost nobody talks about: capital allocation. This is how you divide your money. You don't put equal money everywhere. You put more into high-confidence opportunities and less into risky ones. This is how smart investors maximize returns while controlling risk. Another key factor is adapting to change. The U.S. market evolves constantly. New technologies come in, old industries slow down, trends shift. If you stay stuck in old thinking, you fall behind. That's why flexibility is important. You need to adjust your strategy based on market conditions. Now, think about this. There are times when the market rewards aggressive strategies, and there are times when the market rewards patience and defense. Knowing the difference is what makes you smarter than the crowd. Let's talk about long-term vision. The biggest wealth in the U.S. market is not made in days or weeks. It's made over years. Companies grow, industries expand, innovation drives value. If you can identify strong long-term trends and stay invested, the results can be life-changing. But this requires belief. Belief in your research, belief in your strategy, and belief in the process. Now here's something very real. Losses are part of the journey. No investor wins 100% of the time. Losses are not failure, they are lessons. Every loss teaches you something: what went wrong, what to improve, what to avoid next time. The goal is not to avoid losses completely. The goal is to manage them. Because if your losses are small and your wins are bigger, you still grow overall. And finally, let's talk about independence. Don't blindly follow others, not influencers, not random tips, not hype. Build your own understanding. Because when you depend on others, you lose control. But when you understand the market yourself, you gain confidence. And confidence leads to better decisions. So at this level, it's no longer about just entering the U.S. market. It's about mastering it step by step, building habits, creating systems, controlling emotions, and thinking long term. Because in the end, success in the market is not about one lucky move. It's about becoming the kind of person who makes smart decisions again and again. And once you reach that level, the market is no longer confusing. It becomes an opportunity.